People who are under allocated to the gold, it's a lump sum. The SIP, one can have a significant amount or at least reasonable amount via SIP in gold.
In India, I think, like Warren Buffett once said, I don't understand gold. I don't understand people dig a hole, get gold out of it, dig another hole to store that gold. Now there is a technology which is proven that copper contacts are equally efficient as compared to silver contact, maybe 5% lesser. If you were to think of a normal rational world, we are positive on market. So from a portfolio perspective, gold is more structural. Silver, if at all, has to be more tactical if you understand the demand supply dynamics.
Thank you for your time and appreciate. Actually, we are meeting first time. I am personally following you at least from more than a decade now. Maybe our team might realize that as I was talking to you, that in 2024, starting 2024, when there was a euphoria on the small and mid cap side, and we were actually not asking people to give money in a small cap, but we thought, though people are coming and they are likely pushing us to that they need a small cap, and then we thought that if we need to give someone who is maybe rational and may not get carried away in terms of at least on the price erosion perspective or valuation perspective, we introduce only your fund in the client's portfolio at the peak of the cycle. So on that, so again, thank you for that, and thank you for accepting our invitations on the short notice. So again, to start with, because again, as Bijal said, you are the sort of authoritative voice on the gold. At least people follow you when you speak on the gold. Current in terms of whatever the geopoliticals and whatever the trade tensions are there, what are the triggers or maybe sort of the price levels at which you will expect to trim down the golds? You gave all the reasons why one should have a gold in the portfolio, but also give a reason or maybe a price or a trigger which you might think that you would like to trim down the golds.
Yeah, so we look at fundamentals, right? And biggest fundamental for gold is money. So if the chart that we saw of money backed by gold, right? Gold as a percentage of monetary reserve. So there we are currently at 20%, right? If you have to move closer to that, even that 40% mark, it means a price of somewhere around $7,000 to $8,000. So even if fundamentally, if we say that 40% has been the long term where most money was supported by gold at that level, then probably we are at least staring at $6,500, $7,000 gold price. The factors are still very, very positive. So gold moves inversely to the trust and confidence in the monetary system. So if there is more trust that you see in, say, if US starts behaving well, right? They say that we'll try and reduce our deficit, which is still 6% of GDP. If they say that we will try and reduce our debt over time, those are the triggers which can lead to gold price going out of favor. But until that happens, there is one very peculiar thing that, politicians who come to as elected people, they can only get elected if they tell you good things. We'll give you free education, we'll give you free transport, we'll give you free everything. If someone tells you that, I am not going to spend on road, I am not going to give you free education, I am not going to give you free medical, will those people come to power? They will never come to power. Even rational people like us will never vote for those kind of people, saying, why do I pay taxes? I pay taxes, you give me all these free things, which doesn't happen in India so far. But globally, people will only come to power if they promise various free things. And hence, if they have to get re-elected, they will always want to run deficit. And deficit builds onto the debt levels of countries. So that's the premise. If that is the world that we live in, gold will always be relevant, right? Because money loses value when they give you free things. because they don't have enough taxes and they gave you more free things, so they run deficits. And hence, even now, if you look at various programs done by governments in India, over time they have started to give more freebies. So if that is the case, then probably gold will remain relevant. And I think in this cycle, and if you were to match the gains that we have seen in previous cycle, also it matches to a price which will go around $6,500, $7,000, which is far higher than current gold price. So many things point to a similar gold price, but trigger that you will have to judge is where are real interest rates, what is the dollar likely to do, what is the strength of the US as an economy. If all those things you get a negative or a neutral mark, you need to have gold in your portfolio. And with the current dynamics, probably I don't think that $6,500, $7,000 looks too far from the monetary dynamics that we live in today. So that gives me more, and of course, when we feel that it's gonna be a bad time for gold, we will write. It's not that we'll always give you a positive view on gold. I remember a few years back, or maybe 10 years back rather, we had, or I think it was 2013 if I recollect it well, we said that it was Dhanteras or Akshaya Tritiya again. We said if you have to participate this Dhanteras or Akshaya Tritiya, do only token, don't buy big, because things were not good for gold at that time. And we saw gold languish for 3, 4, 5 years. So we will let you know, of course, but these are the triggers that you see. But today gold looks very, very comfortable to where it is today in terms of what the future holds.
So what would be your advice the people who are under allocated to the gold? It's a lump sum, or you still think the SIP one can have a significant amount or at least reasonable amount via SIP in gold?
So I think if you have not good allocation, like someone was telling 2-3%, right? If it is less than 10%, you should do lump sum and then probably build something as you go out. So I think it depends on what your allocation is. But in India, I think like Warren Buffett once said, I don't understand gold, right? I don't understand people dig a hole, get gold out of it, dig another hole to store that gold. I don't understand what's happening. I scratch my head and say, I don't understand this space. But eventually Warren Buffett also bought gold. And especially for people who live in India, countries, because Warren Buffett had never lived in any other country, or especially in emerging market country like India. Indian markets, or we as Indians, have bared the brunt of rupee depreciating by 3-4% a year. That's a loss of purchasing power. So if you have the currency depreciating by 3-4% every year, which we don't see changing, you need to have assets like gold. So I think gold from an Indian perspective is very, very important in one's portfolio, and that is why not 2-3%, 10-15% is the ideal allocation.
So this is, so if you have, let's say, 10 to 15% in gold, what would be your outlook or maybe your views on the silver, which is another sort of commodity?
Sure. We always get this question. Silver, after all, is a poor cousin of gold. And people say gold affordable nahi hota hai, chandi to le le. Right? But if you look at silver mein, there is more narrative as opposed to real fact. क्या कहा जाता है कि everything sustainable, everything green, everything EV uses a lot of silver. यही story सुना है आपने? Absolutely. Right? लगता है solar panels में silver लगता है. I have no doubt about it. But if you look at hard numbers, aggregate demand for silver over last 3 years is negative. तो कहाँ जा रहा है चांदी? इन्वेस्टर पोर्टफोलियो में, रियल चीज़ों में नहीं जा रहा है. Investment demand for silver last year was up by 300%. Actual demand was -2%. So it is more narrative as opposed to real fact. And to give you one statistic, a commodity is viable till it is price viable. वरना क्या होता है? Substitution. Silver used in solar panels. Just because of one technology, the silver paste लगता है solar panels में, there is a silver paste been applied. तो silver paste का use because of one technology went down by 30%. पहले सिल्वर यूज होता था सोलर पैनल कॉन्टैक्ट्स में. नाउ देयर इज अ टेक्नोलॉजी विच इज प्रूवन that copper contacts are equally efficient as compared to silver contacts, maybe 5% lesser. 5% efficiency loss के लिए you are getting copper which is 200 times cheaper than silver. Will you not use it? So silver, I think, is narrative. And coming to your point on portfolio context से देखेंगे तो silver is an industrial commodity. 65% of the usage is industrial. Industry कभी अच्छा करेगी जब इकोनॉमी अच्छा कर रही है. इकोनॉमी अच्छा कर रही है तो आपके इक्विटी क्या करेंगे? अच्छा करेंगे. So it gives you the same factor as your equity gives you, or same exposure that your equity gives you. जब भी crisis आया है 2008, 2020, equities have gone down. Look at what silver has done. Silver has gone down along with equities. Gold has moved in the other direction.
Equally volatile. Equally volatile.
Equally volatile, and it has gone down. It has not protected portfolio in times of stress. And gold has done that. So from a portfolio perspective, gold is more structural. Silver, if at all, has to be more tactical if you understand the demand supply dynamics. So gold होना चाहिए 15%, silver होना चाहिए 0 to 5% maximum, even if it is.
So now you touched the interest rate also in your communication. So let's say suppose if the saying say longer, higher for longer, if that stays,
Correct.
so how do you think the gold performance in that era?
ठीक है, if interest rates remain high for a long time, right, gold कोई interest नहीं देता है. So if interest rates are rising or high, then people will move out of gold to interest payment. But rather than even interest, what moves gold is real interest rate. Real interest rate, what it is interest rate minus inflation. अगर वो positive में है तो gold के तरफ people will not go. But today, if interest rate remains high, the prospect of inflation to remain high is equally high. That is one. So I don't think real interest rates will shoot up significantly from here. Second, central bank का हमने debt देखा. US का 125% of GDP is the debt. Today, 2.5% or 3% is the average interest that they pay on their debt, right? At that level, they are paying $1 trillion in debt payments, interest payments. Imagine if interest rates were to go to 4%. What will happen to their interest payments? Almost double. Because rollover will happen at a higher rate, right? So, they will not be able to afford it. So, US will try to keep interest rates low as much as they can. इसलिए पावेल और फेड का ट्रम्प का फाइट होते रहता है. Trump was trying to send him to jail, right? So this man can do anything, of course, but you know, they cannot afford high interest rates. That's a given, right? And hence they will try to keep interest rates as low as possible, try to keep inflation as high as possible. Because debt is seen as a percentage of GDP. कभी भी debt ऐसा बोला नहीं जाता कि टोटल डेट कितना है कंट्री का. डेट जीडीपी के परसेंटेज पे कितना है. तो अगर डेट कम नहीं कर सकते, क्या करेंगे वो? जीडीपी बढ़ा देंगे. कैसे बढ़ाएंगे? रियल चीज़ तो कर नहीं सकते, प्रोडक्टिविटी तो ला नहीं सकते, तो इन्फ्लेशन हाई रख के जीडीपी बढ़ सकता है. जीडीपी, नॉमिनल जीडीपी जो होता है is nothing but real GDP plus inflation. तो इन्फ्लेशन हाई रख के आप जीडीपी को बड़ा कर सकते हैं, और उस वजह से the debt to GDP as a number keeps looking constant or lower. And that is the game that they are playing today, right? So
keep that perspective. I think this is good, interesting perspective that what sort of game they are playing and why that game they are currently playing. Now, I think as you speak also that you are constructive on the economy.
yes,
But considering current geopolitical and the uncertainty event, specifically any India-specific opportunity beyond gold, which is you think underappreciated, and you think one should take a look at those.
yeah. So I think if you look at our economy, until this war happened and oil prices went up, availability of energy became a challenge to many industries, to households, to hotels, etc. Economy was shaping up very well. We had 1.5 years or 2 years of lower growth that we saw from 24 till now. And that lower growth was a cyclical lower growth, not a structurally lower growth. Right? If you look at most of the things were improving very well. Credit growth was at 15-16%. If you had looked at exports were growing. If you looked at various fast frequency or high frequency indicators were improving across the board. Two-wheeler sales, four-wheeler sales, all that was improving very well. Showcasing that economy is coming out of the doldrums and starting to improve. But this crisis hit us. It's not so much about the oil prices. Of course, at a certain high level, it starts having a disproportionate impact on the economy. It's not a linear impact. When oil goes to 80, there's a different impact. At $100, there's a different impact. And at $120, there is a very high impact, right? So that was a challenge for us, and that could have derailed, because if industries are shut, there will be layoffs. There will be, and this crisis was Middle East crisis. There are a lot of Indians working in Middle East. They would have come back. So we already have an employment problem. It would have increased that problem many-fold if these people were to come back to India. So Indian economy was challenged. What was a growth that we were starting to see got a shock because of this issue. And hence, what reaction we saw on markets was very, very real. We also went back to our drawing boards and say, well, how will our company's earnings get impacted? And therefore, we kind of were taken aback because the impact was very large. And as I said, if oil prices would have gone to 120 and stayed at 120 and averaged at $120, we would have a very real implication on the economy. But thankfully, it's come down below 100 very fast. Availability is improving. The ceasefire happened, and there was yesterday there was a news that shipments have started. So that is a very great news for us. So if this was a short blip, then again we will be back on track with the economy. There will not be the implication of the stress test scenario that we were looking at. So from an economy, if it goes back to normalization, what are the opportunities that we are seeing? We are seeing opportunity in BFSI. BFSI looks extremely good to us with credit growth picking up. So there will be levers for banks, and probably there is always a dichotomy that PSU banks or private banks, right? So PSU banks probably had a good run when private banks didn't have. And there was a reason, because because of declining yields, they had treasury income, they had fee income increasing, that led to benefit for the PSU banks. Their costs were low, and they got very, very aggressive with lending. PSU banks are okay working with 1% ROA. Private banks, given the bent that they have, they need 2% ROA, right? And when credit growth picks up, when credit growth is challenged, everyone is looking for the same customer, and when you have funds or banks operating at a lower profit, you will go to them, and that is where they benefited. But going ahead, I think private banks will benefit much more, because the best of the run that PSU banks had is probably behind us, and probably the next phase of growth where credit growth will be there and they will be able to earn the ROAs that they want, will lead to benefit to the private banks. So within the BFSI, we like across the space, we like insurance companies, we like private banks, and we like the ecosystem plays that are there. We like across the board, especially the proxy plays, not on the stock side, but on the mutual fund side. So that's the play that we like. AMCs also we like, certain where valuations is comfortable is what we like. Uh, and of course the wealth managers, they are expensive, but the growth is there for even those plays. Uh, Next we like is consumer discretionary, especially autos. So we had gone through a fairly bad cycle with GST cuts, etc. We saw that impetus coming back to two-wheelers, four-wheelers, etc. So I think that cycle will still play on as the economy recovers. There will be demand across for auto ancillary, etc. So that is the play that we like. Third play that we like is also, a bit challenged at this time, but we think that the fears are overblown, which is the technology sector, right? The AI is there for real. It will change the way these technology companies do business, but the valuation at which they are available today is attractive. So I don't think that you can buy a significant chunk, but this is a time to start looking at that sector and start investing in that sector. It can go down from here. For example, tech companies during the cloud days were at 15 times PE. Today they are at 17 times PE. AI is a bigger disruption as compared to cloud. But if they capitalize on this AI thing, the integration opportunity is far bigger as compared to what was in cloud. So, from a risk reward perspective, it looks good at this point in time as opposed to what it was a year back, right? So these are the 3-4 plays that we like significantly as an opportunity where growth is going to be there, plus valuations are in your favor.
So on the economy side only, do you think that the financial year 26-27 we will see another blow on the EPS or a quarterly performance maybe in the Q1?
So Q1 could be challenging, especially for certain sectors. There was nervousness again, and hence Q1 could be to some extent, because things will take its own time to normalize. So Q1 could be challenging. Even the year 26-27 is not going to be a runaway from an earnings standpoint. It will be a good improvement from what we saw last year. Earnings which were, close to low double digits will probably move to mid double digits this year. And year 28 is where we see a big impetus on earnings. So if you are just banking on this year and say, "Mera return ek saal mein ban jana chahiye," that's not going to happen. You will see markets moving up slowly, gradually, but as you see and get confident about the 28 numbers, probably mid-year, that is when you will see a strong push in the market. So you will have to be a little more patient. This run-up that we saw last 10 days or last few days was just a normalization of the stress that we saw coming into our economy. And as that normalizes, probably you may have to wait or be patient, because the recovery is not going to be what we saw last few days. It's going to be gradual in nature. And as you get comfortable with one more year of earnings, and there is visibility to that earnings, as you see fast moving indicators shape up well in the economy, that is where you will get confident and markets will get confident to price that in. So probably it will be patient, but these are great times to invest.
Also, if you look at least in last 12-15 years, since maybe 2014, somehow India is getting one after another some events. The moment you see some recovery in terms of economic, you have some loss, starting from demonetization to ILFS to then GST we launched, then maybe probably your COVID happened, then let's say suppose today AI or the geopolitical situations. So, what sort of structural maybe reforms or a policy moves do you think which can uplift the India growth story for the coming decades?
Sure. So, most of the things that you said, the events that you said, people term this as black swan events, right? Are they really black swans? Right from 1990s till now, we have had about 27 of these kind of events, right? And only 4 of them probably were black swans. Rest were to some extent predictable, right? Or you could see in terms of price that into your numbers. Like demonetization was a black swan. No one expected that, it happened. And it was a self goal in some sense. It was a self inflicted wound as opposed to anything happening externally. So I think you can price many of these things. From a reform perspective, where we need to, as a country, need to give more importance is jobs. Anyone has a number in terms of number of jobs that we need to create in India?
Maybe 80-90 lakhs a year.
80-90 lakhs a year. Yeah, I think it's. I mean, to keep a lot of people. Yes, we need to a lot of jobs, but the number comes closer to about 28,000 jobs per day over next 10 years is the jobs that we need to create in India. And there is no thinking on those lines at how are we going to create those jobs, right? So if someone asks us what is the biggest risk in India, is our inability to create these kind of jobs over time. Because today, if a educated youth coming out of college, right, is not landing up in a good job, what happens? So gone are the days when people were coming in the workforce and were undemanding. Now the youth today is well educated, well connected, does not end up in a good job. What happens? There will be a civil crisis. There will be riots on the street. Because these youths are well connected today because of social media and other things, right? If they all end up with a similar state of not getting a good job despite a good education, then probably they'll come on the streets. So that is one of the biggest risks that we see in India. And there is no strong policy, and AI and things will even accentuate it, right? As opposed to reducing it. So I don't know, there is no easy answer to it. I would not blame the government, but from a government perspective, there is not enough thought process towards how are we addressing this issue. So I think those, along with land, labor reform. So if you want to, have India as China plus one, for example, we are not doing anything to enable that China plus one. Is China plus one real? Anyone? We don't think so. In certain areas, yes, where we have an edge. For example, pharma, we have an edge. We have, great people, great research bent, etc. We can do wonders in pharma. So we can be pharma China plus one. But in manufacturing, can we be? We have land, we have labor issues. People in the West are used to hire and fire. Do we have that policy in India? We have labor unions. We have many things that, politically motivated, that will not allow for these things in India. So what we need is, relaxation on these reforms. And when I spoke about China plus one, if an American company decides that, I want a source or a factory in addition to what I have in China, will they come to India? Probably not. Why? Because it's not the one person who decides in the US sitting in that office to say how to start the factory. It is the person who has built the Chinese factory or is running the Chinese factory is more likely to be appointed to go to India to start the factory. And what will that person's preference be? Firstly, we were not giving for a long time visas to Chinese people. That was a bottleneck, which is now getting addressed to some extent. Second is if the Chinese person is given, say, you choose where you want to like to open a new factory. They will choose probably Asian countries, not India, but Indonesia, Vietnam, etc. Why? Because there are those people who eat alike, speak alike, look alike to the Chinese counterpart, not India. Plus, we don't have that labor advantage or a land advantage to start things easy. It's easy to say we are moving towards ease of business, which we have moved, but it's far from what the reality is, what they need is. So we have that potential. Probably we need to work on these areas where we can certainly become the China plus one. Until that, it's just talks and certain areas where we will succeed because we have an edge.
So you also touched upon the technology as a sector. So do you think, considering what's happening in the AI, what would be your advice to allocate money on a staggered way, or have some percentage of money lump sum and maybe then staggered it? What would be your advice?
Yeah, so we bank, like we would not, tell you that if this happens, this will happen, or if oil prices are here, this can happen. Of course, there is a stress when these things are challenging India's economy. We don't know where oil prices will head because we don't know what's happening in geopolitics, which determines the oil price. But if you were to think of a normal, rational world, right? As I told you, we bank on one number to say that is this market attractive, because that emanates from ground research. Earnings are driving that. And from that standpoint, what was a September 24, where our upside potential was 10-11% absolute for 2 years, we have come a long way. It now is in the dark green zone where 2 years return potential is above the long-term average. So I think we are positive on market, and when it comes to these kind of scenarios, it's not that we are looking at a scenario which was as white or light green, where you need to think whether there can be further large impact if there is anything that goes wrong externally. Even if things go wrong externally, it still emanates to a good return potential over next 2 years. So I think this is the time for lump sum as opposed to going a more staggered manner, and probably place where there is a valuation comfort. So if you look at portfolios and look at the current PE, the earnings growth potential and the PEG, and if you get comfortable with that kind of valuation, of course certain pockets are still very, very expensive. There is growth. For example, power sector, there is growth, but it's still very, very expensive today, right? So will you make significant amount of money in those sector? You may make some amount of money, but is it going to be significantly large? Probably it can get challenged as things normalize going forward. So you will have to scout for pockets of opportunities, be comfortable with the valuation, be comfortable with the growth prospects, and if you have that rational approach, it's a great time to invest in market.
So on a broader market perspective, we can look at unconstrained strategies where you can put lump sum, because that's where the fund manager will allocate.
Yes.
What about, let's say, suppose you touched upon the technology sector, basically. What would be your view in terms of, do you want to, you would want to advise some sort of allocation now and then staggered allocation later on?
Yeah. So technology, yes, that can be the approach, or even in technology, given that, if you look at commentary of companies, it's still not that strong. So you can nibble your way out, stagger your buying, and build your allocation. So that could be an approach in technology. But if you were to, put in terms of indexes, probably large and small cap look okay. Mid cap probably looks expensive, even as an aggregate. But given that, there are still pockets of opportunities which are better. So an approach to go with an active fund manager and allow them to take the bets where they see growth prospects, where they see comfort on valuations, Probably that would be the right way, as opposed to, going passive or going sectoral way. I think this is a time to allow that active fund management to do well, as opposed to taking your own bets.
So give me, let's say suppose the cohort of the senior citizen, the people who are maybe 55, 60 plus, what would be your advice? Will you advise them to trim down some sort of allocation where we stand today, or you think for them also we can inch up the equity allocation?
So we are often being asked this question, right? What a 50, 55, 60-year-old should do. So see, every circumstance is very different, right? We don't know what is the bankability on the cash flows or on these investments for their regular requirements. So if that is, then probably it is advised that they, as they age, they reduce their allocation. But if I take a view that it's going to be for long term, passing wealth to next generation, etc., and if the motive is to grow wealth, then probably I would say that, this is a good time to put money in equities. Is this a time to go shy, like 24? No, of course not. Is it a time 25 where things look undecisive to some extent? It's no. It's a time where you have enough visibility on the economy, and therefore you can go out and put a large lump sum allocation to equities.
So I just, do you see yourself in the wealth management industry or investment management industry? How do you look at AI? Is it an enabler or is it a disruptor?
I think AI across the sectors, especially in financial world, it's a great enabler, right? To give you a very small example, we have on the global side, when clients come to meet us, they have also been asking, how do you use AI into your use on your day-to-day things that you do? So we are using AI or adopting AI very, very significantly. Does that lead to less number of people? No. Because I'll give you two examples in terms of activities that we do as fund managers, as analysts. If I have to analyze last 10 years of con calls the company has done, right? If I want to get key inputs from those con calls, AI is a great enabler. In like 5 minutes, I can analyze 10 years of con calls of companies. 40 con calls. Every quarter they do a con call, 10 years. 40 con calls, key data I can get in 5 minutes. But at the same time, when I have built a conviction on a company, I need to decide how much I should buy. I should buy 2%, 3%, 4%. AI can't do. I have to sit across the company management, build that conviction in the management, build that conviction in their future plans, build their conviction in their numbers, build their conviction in their balance sheet to be able to decide, is it going to be 2%, 3%, 4%. So AI is a great enabler. Can they replace humans in terms of deciding what portfolio needs to be built or how it needs to be built? It can't do.
Maybe one last question, maybe personal basically. So if you go back yourself maybe 20, 25 years back, and now if you look back your career as a personal professionals, what has worked for you? Wherever you stand today, because of which are 2, 3, or which are those qualities had paid wherever you stand today?
So I strongly believe, when it's come from learnings working with Ajit over time, that there is no replacement to honesty, integrity, and hard work, and sincerity, as we call it, right? So I think the bent on research, the bent on governance, or identifying which managements are trustworthy, which are not. Over 20 years or last 30 plus years, when Quantum has operated, not to have a single lapse in portfolio. No Satyam, no DHFL, no ILFS, no Yes Bank, no Jet Airways, none of these companies in the portfolio goes to tell the bent that we have, and that's come through assessing and trying to assess the trustworthiness of those companies. So that is a great learning for me, and which has helped me in my career significantly. Even on a personal level, to identify people, the right people to work with, etc., and build good teams, that has come really helpful in terms of building what we have built. So I think having the highest integrity, having the highest sincerity towards what we do, and putting investors in the center of whatever we do has gone a long way in terms of our learnings and the rewards that we have got.